First of all, yes, I am for those of you who don't know me, I'm the regional manager in Ontario for TE Wealth. I'm also the head of financial planning nationally. And have been conscripted, I guess, to do tonight's presentation. Our actual U.S. expert managed to take the trips across the country and go to Vancouver and Calgary and to Montreal, but when it came down to doing the presentation in his home city, he decided to go to Iceland. So, not the United States, actually, but to Iceland. So I am kind of, I guess, the backup plan, and I'm sorry for that for you people. But I do have a lot of clients who are U.S. citizens and have U.S. properties and so on. So I'm quite familiar. If there are any questions, though, we'll just email them to Brent, and hopefully he's still up and can answer them. So I'm going to talk today about a little bit about the U.S. real estate market. I think we've all kind of seen what's happened there in the last few years, but I will touch on it a little bit. I'll talk then about Canadian snowbirds, which I imagine some of you are, and talking about spending time in the United States and some of the things that have popped up in the last few years that we're starting to focus on more. I'll talk a little bit about owning U.S. real estate as a Canadian, and then lastly I'll touch on the dreaded U.S. estate tax, which I don't think enough of us are too familiar with, and something we should all really be careful of, even as Canadian citizens and residents. So starting with the U.S. real estate market, what I have up here is a chart showing both the average and the mean return on real estate over time, house prices. And you're looking back from 1963 up to 2013, so over the last 50 years. And I think it's probably not something that would surprise anyone in terms of a pretty gradual run up until about year 2000, and then this massive upward trend that sort of pushed real estate way up, followed by a massive drop on the other side when we had the crisis in 2008. But maybe surprisingly is this sort of run back up over the last few years, where we've seen a lot of people moving back into this market. The second chart sort of shows the same thing, but this just looks at the average house, so it's sort of that middle level house and what's actually happened for that. The red line takes inflation out of the picture, okay? So if you remove inflation and you take sort of the mean, the real return out into the picture, you can see this flat line of growth over time. And the interesting thing that I took from this was, and I get a lot of my clients saying, well, you know, the market has been really kind of crummy, and I think I should move money to real estate, and you know, I think that's a much better market to be in. The actual return over time from 1970 to 2012 in the United States has been about 4% in real estate, which I think would surprise a lot of people, because we have generally sort of, I think, experienced that run-up from 2000 to 2008 and use that as our guide for what's actually happened in that market. And it's actually been a relatively low return. When you get into what Andrew was talking about, you start adding rents into the picture or income into the picture, is where you start to bring those returns up to the same kind of level that you would get in the stock market over that time. But the actual physical return of a property is actually not that high, really. So what's been happening in the market? You've seen this big rebound in the market. The strength of the Canadian dollar is sort of pushing Canadians now where it's actually very attractive to buy U.S. real estate, and has been over the last few years. You've seen a big drop in the market causing quote-unquote low prices in the United States, especially in Florida and in Arizona. And the strength of our dollar has had a lot of our clients especially asking, is it time to go in and buy properties in the U.S.? And you know, because basically you can pick them up at what we might consider cheap. I'll talk about whether that's the truth in a minute. What's interesting, though, is for those of us who do already own U.S. properties, you really would prefer a falling dollar at this point as opposed to a rising dollar. And so for those of you who haven't bought yet, according to TD Bank, you might actually want to get in there quick because they're forecasting that the loonie is actually going to fall to 90 cents by the end of 2014, which of course will make those properties more expensive for you. So we've got a couple of examples of how this would work. I'm not going to dwell on these too long, but they're fairly intuitive. If your property is appreciating in value and the Canadian dollar is falling, how would that work for you? So in the example, and the same example is used in all, so I'll go through this one in a bit of detail and then use the others quickly. You've got a U.S. property that you purchased for $250,000. Okay? In the meantime, since your purchase at par, the dollar falls to 90 cents. Okay? You later sell your US property for $260,000, so you have a $10,000 gain in US dollars. Okay? So when you sell a US property, even as a Canadian resident, Canadian citizen, you have to file a US tax return. So on that US tax return, you're going to recognize a $10,000 gain, pay tax in the United States on that $10,000. Okay? Meanwhile, in Canada, though, your gain is not $10,000. Your gain is actually $39,000, caused by not only the gain in the property, but also you have an exchange gain. Okay, so in your $39,000, you pay tax in Canada on that, but you do get credit for the taxes you paid in the US to offset some of that. Okay? So you can see as the dollar falls, you actually make more money because you have to factor in the exchange rate. If we look at a situation where you have the property appreciating but the Canadian dollar also rising, which would have been happening over the last few years, again, the same example, you bought it at $250,000, but this time the Canadian dollar has risen to $1.10. You can see that you sell the property for $260,000, you've still got that $10,000 gain in the United States. Okay, so you're going to file your US tax return, pay tax on your $10,000, but unfortunately what happens in Canada is you actually have a loss. Okay, and you can't use that against regular income, you can only use that against capital gains. And you don't unfortunately get to use the tax credit on the US side because you have a loss on the property in Canada. So you've sort of $2,000 or so dollars spent in the US on tax is kind of tax paid for that property on the US side, no recovery of that in Canada. Okay, so you really want that dollar falling once you own the property. If it's rising, it's not really doing you any good. Lastly, just looking at the reverse of that, where the property is actually falling and our Canadian dollar is falling at the same time. So this gives you a little bit of protection even though your property is falling. So again, you have the situation, $250,000. You sell the property though now for $240,000. So you've got a $10,000 loss in the US. You do have to file a tax return. And as I'll show you later, it's not too simple to do that, but you file your tax return, no tax owing because you've lost money. Okay, so they're not actually taking your money if you've lost money. The IRS can do things like that. However, in Canada, you actually still have a gain. So you've got a tax gain in Canada, you pay tax on your gain in Canada with no offsetting recovery of foreign tax because you didn't pay any. Okay, so just trying to show from those examples how much actually the exchange rate plays into this when you're investing in the US as not just the property value. And Brent put this in. Obviously, these are not my slides. I actually have no idea what that means, but I think it's pretty cool looking. I think it's trying to show about the deep freeze in the US real estate market. I just think the guy on vacation looks a lot like me in a bathing suit, so I thought it was pretty cool. My wife said I'm skinny fat, whatever that is. Okay, so for people spending time in the US, and I think this might be why a lot of people are here, people who are snowbirds or want to spend some time in the US, one of the things you have to be really careful of, and this is what's really been sort of pushing through in the last few years. As you remember, or you may have seen in the news, there was a guy in Switzerland who stole a whole bunch of records from a Swiss bank, got in trouble with the IRS, and then decided to get out of trouble with the IRS, he'd give them all the records to try to save his own skin. And the IRS said, sure, we'll take stolen property. We're fine with that because the rules don't apply to us. And what they've started to use that for is to find people who are US citizens or people who should be paying tax in the US who aren't. So in Canada, you pay tax based on residency. So you are a citizen of Canada and live in Dubai. As long as you're considered a resident of Dubai, you don't owe any Canadian tax ongoing. But if you're a citizen of the United States working and living in Dubai, you still have to file a US tax return. Okay? So they're looking for all these people around the world who are US citizens who are not paying tax. And this has led to this advanced sort of, some of these changes in the US government actually, where they're really trying to integrate all the different areas of the government to talk to each other. So Border Patrol, with the IRS, with the US Treasury, all trying to filter through so that if you're crossing the border, lo and behold, the border guard might be asking you, have you filed your US tax return? Or I noticed you spent so many days last year in the United States, have you filed a closer connection form? Okay? And we can see this leading to a point where you might be even denied entry if you haven't filed over a number of years, or lead to a point where you're caught not filing and cause you to have penalties or tax. So what they start with is, for the United States, they do what's called the substantial presence test. And they want to see, If you fail this test, you are considered a resident of the United States for tax purposes. Okay? And it's actually a lot less than what most people would think. So I think most people think if they go to Florida, and as long as they stay less than 6 months a year, they're okay. I certainly know that's what my parents are working on, that assumption, okay? Because they're down there all the time, okay? But that's not how it works. So how it works is you look at, assuming you have to pass this, you have to basically fail this test to be considered a resident. First, they look at how many days in the current year, if it's over 31. So, you know, if you're down in Florida pretty regularly, that's pretty easy to do. Then you're going to look at how many days was the total for the current year. So for 2013, going back to 2012, how many days were you there in 2012? Okay, add that. How many days were you there in 2011? We're going to take 1/3 of those days. How many days were you there in 2010? We're going to take 1/6 of those days. So we're going to add up current, 1/3 of the year prior, and 1/6 of the year prior to that. And if they pass 183, you're considered a resident of the United States. Okay? So that essentially works out to about 4 months a year. Okay, so if you think of your parents or yourselves, if any of you are snowbirds, I know for my parents, they go down in about the beginning of October, and they come home, well, they come home in about maybe April. Okay, so they're way over 4 months. You know, my mom comes home at Christmas, but my dad stays there. He's too grumpy to come home for Christmas. But so, you know, so basically, it's very easy to fail this test is what I'm trying to get at. And so many people who are out there are actually residents of the United States and don't realize it. And the interesting and great thing is that partial days actually count as full days. So I know if you're heading back from Florida and you're driving back and you've got that day and you decide, you know what, let's just stay in Buffalo for the night and we'll do a little shopping in the morning and head home. And, you know, I don't know why you'd stay in Buffalo, but if you wanted to, you'd stay in Buffalo, do a little shopping, and you're there for 2 hours in the morning, head home. Well, that 2 hours actually counts as a full day on this basis. So you have to count all those days up. Now, there are exceptions, which are listed there. I think my favorite is that if you're a crew member of a foreign vessel, so if any of you are in the Navy, the Canadian Navy, don't count those days when you were docked in San Diego or whatever. But for the most part, you know, other than when you're traveling through on a stopover or something, for the most part, you're in the U.S., you're considered resident. And or considered days counted. And one of the other things there that I find, and I've just, again, some of this is just going through this with my own parents, is when they think of their visits to the U.S., they think, oh, yeah, we were in Florida at our place there, and then we came home. So they just added a lot and said, well, what about the week you went to Chicago in the summer? Oh, that counts? Like, yeah, that counts. Or what about the weekend you spent in Buffalo? Oh, Buffalo? Okay, so that all counts. So you have to actually go through the year, and you find it's actually a lot more than most people think they're at. So more than 4 months, you're considered a U.S. resident, essentially. Okay? So what do you do to get around this? Okay, so there are ways to avoid this. So if you're a resident of the United States, it means you must file a U.S. tax return. Okay? However, you can avoid it. So you file what's called a closer connection form, or Form 8840. Okay? And what the form basically says is, yes, I failed the substantial precedence test. As far as you're concerned, based on that test, I'm a U.S. resident. However, I have a closer connection to another country. And in this case, it would generally be Canada. So I have a closer connection to Canada because I live there, my house is there, my kids are there, my job is there, I earn all my income there, my pension's from there, blah, 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 blah. All my ties are to Canada. They ask, like, where's your driver's license? Do you have medical coverage from a province or a state or country kind of thing? So all those things you answer on this form, you send it in, and they say, okay, you don't have to file a U.S. tax return, which is great. Now, the only caveat with that is, and again, luckily, my parents are a great example for you all of what not to do. You cannot go over 183 days, okay? So many people, again, will look at this and say, well, I looked into the OHIP rules, because most people I know when I talk to, OHIP, I got to make sure I keep my OHIP. So the main thing with the OHIP rules, generally the number is 212 days. So don't be outside of Ontario for 212, for more than 212 days. So my parents are adding it all up. Don't worry, we're under the 212. And we added in the Chicago, and then we got back and we looked at the Buffalo, and then, oh, lo and behold, there was that trip to Indiana. And so now we got to 189 days. And so unfortunately, they can't file the Form 8840. They now do have to file a U.S. tax return, which of course is an absolute nightmare. Because if you're not a US citizen already or haven't worked in the US and obtained a Social Security number in the past, you have to get a US taxpayer identification number. Okay? And there's so many things that go into this. So you file this 1040 NR, which is non-resident. 1040 is their tax return, basically, the federal tax return, and then the NR being non-resident, so 1040 NR. And you file your tax return. And for most people, it's a hassle, it's a pain. Even for US citizens who we work with who work in Canada, we file their tax returns. You don't owe any tax because as Canadians, we all know we pay so much more tax than them that it usually covers itself off and you usually don't have any tax. However, again, if I go back to that whole Swiss incident and the stealing of documents that the IRS is going to ignore as a crime, what they've done is they've become very sneaky, the Americans. And they don't care about tax so much, really. Okay? Because they realize that most people who live outside of the United States, if they live in Switzerland, or they live in the United Kingdom, or they live in Canada, they're probably paying more tax there than they would have anyway. So sure, you can catch up your tax returns, or sure, you can file your tax return, and we don't mind. You probably don't owe us any tax anyway because you have offsetting foreign tax credits for the tax paid. But what they've done is they've come out with these whole new forms, and this applies to people even in this situation. So Canadians who are spent more than 183 days or didn't file their close-in connection form, who are required to file a 1040 NR, are going to also have to file this FBAR form, okay, which is a really fun form where you list all your bank accounts and you list the high balance for the year in all your bank accounts in Canada. Okay? If you don't file that form, the fine for not filing is up to $10,000. Okay? So yeah, you're not going to owe any tax if you don't file your tax return, but I think you should file the FBAR. So, you know, that's where they really want to get you, and that's what they're trying to do around the world, really. And Canadians have sort of been caught up in this sort of enhanced vigilance. It's not like any of these things are new. It's just that they never cared before. And all of a sudden now they're hiring all kinds of people in the IRS, and they've realized, holy crap, we got no money. We spent it all in Iraq. Okay? We need money. And this is how we're going to get it. Okay? And we've sort of fallen into this. And, you know, we just put a little screenshot of the two forms. But we definitely, you know, we've prepared plenty of 8840s. They're pretty straightforward. It's just a matter of actually keeping in the process of recording your days, keeping track of it, and getting them recorded for us every year. Okay, so one of the other things is if you have a property, and this is, we run into this with clients as well, is you have a property in the States and maybe you're too young to be a snowbird. So you decide, well, I bought this property because the property values came down so far, Canadian dollar went up, it was a steal, I had to buy it. But I'm not going to go down there, I'll just rent it out in the meantime and that'll cover my costs and we're all good. One thing to be aware of is that you do need to file a 1040 NR when you rent your property in the States. So you're required to file a US tax return every year, okay? And the one good thing about that is if you are renting a property and filing that return every year, you do cover off the substantial presence test within the return. And so you don't have to worry about the 8840 because you're already filing a tax return every year. But it's really important if you're renting your property, you must file a US tax return every year. You also record that income on your Canadian as well. And so you do get the offsetting benefits. So around 1980, Costas and I were having a slight debate about when this kicked in. The US came up with something called FIRPTA. Anyone want to guess what it means? I couldn't even tell you. Foreign Investment Real Property Tax Act, I think it is called. Okay? So that's just a long way of saying give us 10% if you're a non-resident of the United States and sell your property there. So basically what happens is, and this is another interesting thing to be aware of, you own a property in the United States and you decide you're going to sell it and you're not a resident or citizen of the United States. When you sell that property, even if you had no gain, so if we go back to our earlier examples and you bought the property for $250, sold it for $240, so you have a $10,000 loss, you still are required to remit 10% of that $240 at the time of sale because you're not a resident of the United States. Okay? Now, what happens is you do that in June of 2011, and you come through to 2012, you file a tax return in April of 2012, and you recover all your money. But you do have that lapse where they've got your money, or that 10% for a while. You can file what's called a Form 8288B in order to have that with the 10% reduced to the net amount. So if you had a gain, we work out what the amount is. it's a bit of a pain. We don't tend to often do this unless it's a really large amount because, one, some states don't actually have the equivalent. So in the US, you have a federal return and a state return, unlike Canada where it's all combined. And so sometimes you don't have it in both the federal and the state side. Plus, it's a bit complicated to actually do. So it's not always the easiest thing to do. And in most cases, we don't do it. Usually you have to get the tenant, the new buyer as well, to buy into it. So it's a bit of a problem. So I did touch a little bit about the taxpayer identification number. You do have to get that in order to file a tax return in the United States. And anytime you're selling a property or renting a property, you got to have that. And I've run into this with clients where it's actually can be a bit of a nightmare because the IRS, if you think CRA is a pain, if you've dealt with the Canada Revenue Agency, the IRS takes that up a whole level in terms of being super annoying, being unrelenting, and really just being inflexible in the extreme. So I had an example of a client so what happens is if you want to file a return, you've got to apply for this ITIN, okay? And to do that, you've got to send them your passport. So I know how comfortable you all would be sending your Canadian passport down to Washington to have the IRS have a look at it and send it back to you. So the alternative to that is you can go to the US Embassy and get them to witness it, or you can go to a Canadian passport office and it takes a few weeks and they'll send you back a copy, and that's generally good enough to be. What happens is you fill out this form W7 with your tax return. It applies for the ITIN, and what happens with the IRS is if you just don't tick one box properly, or you forget to tick a box, or you pick the wrong box, they deny your ITIN and they don't send back your identification. Okay? So think of how happy my client was when they had to go back to the, and getting an appointment at the US Embassy is not a lot of fun either. So you got to be really careful. They're a real pain. But once you do this, it's actually fairly reasonable. But you got to get that identification as a certified copy, either from the Canadian government or from the US to get that done. Okay? Best thing to do is not have to file a US tax return if you can avoid it. So if you're renting your property in the States, things are a little bit different between Canada and the US, very slightly. One of the main things is in the US, you have to depreciate the property as you go along when it's a rental. In Canada, you don't, and in often cases, we don't depreciate it from a tax side because you basically have to recapture that tax when you sell the property. It's often not worth it to actually use the depreciation, but in the US, you have to. And then one interesting thing that I think could catch out a lot of people is if you're going to try to deduct the interest on the property, it must be US interest. So you have to borrow there. Okay, you can't take out a line of credit on your Toronto house, use that to buy your property in the States, and then deduct that interest. Doesn't work. Okay, it's got to be a US loan. Okay, and that's something that I think is very interesting. And you'll note in Brent's excellent slide that FERPTA still applies in any case. Okay, whether it's a rental or a personal property, you still got to give them the 10%. Okay? And the other thing that's interesting that I think a lot of people don't do, because I've actually seen this with clients of mine who rent their properties, is the tenant is supposed to withhold 30% of their rent and remit it to the IRS. Okay? I see you all saying I don't do that. So you might want to look into that because that's something you should be doing. Okay? Technically, they should be receiving the money ahead of time. You get it refunded the next year when you file your tax return. So again, rental property, you got to file that tax return. 1040 NR, okay? Generally, for the most part, you're not going to have a lot of income, but you're going to get a refund, but you got to wait for it. Getting into complications, but I won't go too deep into this, but essentially, the rules are slightly different in Canada than the US in terms of how they determine what you can deduct and how you deduct it in terms of, most people, they have a rental property. It's not just a rental property. So if you buy something in Florida, you'll spend a week here, a week there, maybe a few weeks there when you're still working, and then rent it out the rest of the time. In Canada, it's basically just a percentage. You take the percentage that was available for personal use versus rental use, and you work out your deductions that way. In the States, it's a little bit different. It's based on the number of days you were there, or if it's basically just as long as you're over the 14 days, basically as a rental property, you're going to be considered to be able to deduct the expenses for the rental. Okay, don't think it really matters. For the most part, you're going to deduct what's there. Okay, and then if you don't follow into the vacation rules, you take into the passive activity loss rules, which basically says, and this really only applies if you have other U.S. income, because it's only talking about you can deduct the losses on your real estate rental property against other U.S. income, which really only applies to very few people. In Canada, of course, you can take any of your real estate losses and use them against your regular income. In this case, if you don't meet the rules set out here, you can't against U.S. income, but for most people, that's completely irrelevant. Okay, so for Canadians, tax considerations, you do report your rental income and losses on your tax return just as if it was a property in Canada. Not really much different there. You can use your losses against regular income if you have any. The one interesting thing that people have to really be aware of, so if you own a property in Florida that you use for personal use, you do not have to report that property's value on the T1135 foreign reporting form, okay? So if you're familiar with that form, you tick, do you own property of greater than $100,000 on your tax return? You don't have to say yes when it's a personal use property. If you rent it out for a couple of weeks a year, it now becomes eligible to be put on this form, and you need to report the value of that property on the tax form as well as the income received. Okay, so really important. If you don't file that form or don't fill it out properly, the penalties are $25 a day up to a maximum of $2,500. Really important that that form is filled in properly. This I actually, again, not my slide, but I actually get this one. And this is something I talk to a lot of clients about, and that is, again, stock market crashes in 2008. People don't like the stock market anymore. I get it. Don't like to see us lose money. On the other hand, everyone wants to get into real estate. Okay? Oh, I'm going to buy a rental property. I'm going to buy this, that, and the other. Well, if any of you have been landlords before, I think this is kind of a good capture of what it actually is like. You know, and I always say this to clients: do you really want to be chasing people for rent? Maybe you should look at Andrew's type investment with a mortgage investment corporation, or look at a REIT or something instead, because being a landlord is actually hard work, and I've seen it firsthand where it's, first of all, trying to get rid of bad tenants, trying to find tenants, and then those calls at night where their plumbing is exploded and everything else. So not always the best thing as far as I'm concerned. Okay, so the last thing I'll talk about is U.S. estate tax, and this is another area, I think, where there's a lot of confusion around how this works. So I think if you walked up and down the street and sort of asked people, where is the better tax regime, Canada or the United States? Almost every person you ask would say, oh, it's better to be in the United States for taxes. Canada's the worst, we're high tax, blah, 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 blah. And, you know, I guess for the most part that's true. If you live in Florida, there's no state tax, federal rates are fairly low, it's not too bad. If you live in New York City, maybe not the case, because their tax rates are fairly similar to our own, actually. But where the United States really gets you is at the end. You may say, oh, what do I care? I'm dead. Okay? But I know a lot of us do care. That's why we have wills. That's why we make estate plans and make sure that our families are taken care of, make sure our kids get our money, etc. And so this is where they really get you, unlike Canada. And again, the interesting thing, or sometimes surprising thing to people, is that as a Canadian resident, Canadian citizen, you actually can be hit pretty hard by U.S. estate tax. Okay? So it's set up for U.S. citizens and the like, but we can be hit pretty hard too. And the important point is the same rates apply whether you're a citizen, a resident, or even a non-resident. Okay? Really what matters is what is called U.S. situs property. Okay? Not sure what the word situs means, but probably that it's on site. And those situs assets include U.S. real estate. And one that I think catches a lot of people off guard and by surprise is U.S. securities, even if they're held in a Canadian brokerage account. Okay? So you have your Canadian account full of all these nice U.S. stocks, and who today doesn't want to own Apple? Everybody's got Apple. Well, that held in your Nesbitt Burns account or your TE Wealth investment account is not always a good thing. Okay? U.S. mutual funds. A lot of times nowadays we're actually buying U.S. ETFs for clients, U.S.-based ETFs, not Canadian-based. for many reasons, but they're actually U.S. situs assets. And then anything sort of business related that's actually owned in the U.S. So what is not a situs asset is cash, U.S. treasuries, which are U.S. bonds, U.S. government bonds, life insurance, okay? Certain portfolio debt obligations, and I have to admit that one I had to look up. I wasn't sure what he was talking about, but it actually is mortgages. So if you have a U.S. mortgage on your property, it actually reduces your U.S. estate tax. And then the last thing would be Canadian mutual funds that invest in the United States. So if you buy a pooled fund here through Foyston or whatever, and it's a U.S. fund, you're okay because it's set up in Canada, even though it's buying U.S. securities. So how does the U.S. estate tax work? I don't know if you were paying attention over the last couple of years. There was a big fight between President Obama and Congress, and one of the big things closing out towards the end of last year, I think it was this solving of the U.S. estate tax puzzle. Back in, I'm going to say 2001, I might not have my dates exactly right. So how it works is basically, I'll just quick notes. There's an exemption level, okay, on your assets. So U.S. estate tax is based on your assets, okay? So you die with X number of assets, they exempt the first part, and then they tax you on the next, okay? So if you die with 10 million of assets, right now they're going to knock off the first half, the first 5 million, the balance you're going to pay tax, and I'll show you the rates because they're quite awesome. In 2001, in that category, I might be off dates a little bit, the exemption was actually 600,000. Okay, climbed up to 1 million and sort of gradually climbed up through the Bush tax cuts to the point where it got to 3 million. And then there was a clause where it was going to be repealed in 2010 to 0, 2011, I think. And so there's this big battle. They did a 1 year, they carried it on for 1 year, and then they got to the end and said, we've got to come up with a number. And they settled on 5.25 million. But if they hadn't settled, it could have dropped back to the 600,000 level, which was making people really freaked out because, as you know, everyone's made a lot of money in those 10 years, and they don't want to lose it all to the U.S. estate tax, even though, you know, they all love their government, they don't want to give it to the IRS. So how it works is the first 5,250,000 of assets is essentially exempted. And this applies to non-U.S. citizens as well on a prorated level. So for a Canadian, how this would work is you would take the value of your U.S. situs assets, so your property in Florida and your U.S. securities you hold in your Canadian brokerage account, we'd add those up and we divide those by your total worldwide assets, including life insurance policies. So life insurance is included in an asset, as an asset on your asset ledger. So you'd add all that up, take the percentage, and then you would basically be using that percentage when you work out your estate tax liability. I'm going to get to a bit of an example in a minute. But here you see the actual numbers. So again, if you look at the 2013, we said the level, the exemption level is 5.25 million. So how that would work is that you essentially get up to that 5.25 million level in assets. And anything beyond that, you're paying 40% tax on your assets. Okay? So you're a U.S. citizen, you die with a $10 million estate, you owe $2 million in U.S. estate tax, just for the pleasure of having that U.S. citizenship. For a Canadian, it doesn't obviously work exactly that way because it's prorated to your percentage of U.S. ownership to worldwide assets. But for an example, you have a taxpayer who owns real estate of 1.25 million, U.S. worldwide assets of 5.5 million, plus that life insurance policy for 400,000. The estate tax on that value would be about 445,000. Okay, you see how we work it out there. Taxpayers' unified tax credit is 433,000, which is the 200,000. 2,045,000 is actually the 5.25 million tax value. Okay, so you work out your unified tax credit at 433,000, leaving you with an actual tax exposure of 12,368. So not a big number, but who wants to give money to the IRS if they don't have to? Okay. So how do you avoid it? Oh, sorry. So a couple of little things. If the situs property is less than 60,000, you don't have to worry about it. Okay? So if you have a very small property in the U.S. or a few shares, not a big deal. Okay? You can pass on through the U.S.-Canada-U.S. tax treaty, you can pass assets directly to your spouse. So if you die, the assets can roll directly without having to pay the tax until that second death. And there is foreign tax credit relief if you have to pay U.S. estate tax against Canadian tax, to the extent that you include U.S. source income in your taxpayer income at that point, okay? So if you don't have U.S. source income, even if you have this foreign tax to credit, you can't actually use it. Okay? You need to actually have the income. So how do you reduce your exposure or eliminate it? Pretty straightforward. They're all listed there, so I'm not going to go through them all, just in the interest of time. The biggest ones that we get asked about a lot right now is, if I'm going to buy a property in the States, what's the best way to do it? If I'm worried about U.S. estate tax. So the first thing we do is look at your assets and whether you have exposure. And the common or best way right now is to set up a Canadian resident trust to actually own the property and purchase the property. So you'll need the trust to actually purchase the property. A question I get asked a lot is, oh, well, I already bought the property a few years ago and I just bought it in my name. Well, I didn't think to put my wife on there. Can I just put it in a trust now? Not really. That's really, maybe? No, you can't. So you can't do that. Or could I make it joint? Not really, because it's kind of complicated. You actually are then selling part of the property, which would force a tax return, which would force 10% withholding, and your spouse would actually have to have the money to buy their share of the property. So depending on the value of the property, that could be a problem as well. So really important to set it up properly right away. Used to be you would use a holding company, so there may be some of you who have a holding company who own it, called a single purpose corporation in Canada. Not really used anymore. The U.S. has kind of said, there's been a lot of talk that they would look through those holding companies. And in Canada, they really were allowing you to avoid the Canadian tax rules to set those up in the first place, so they're not too thrilled with them either. You can, however, do that if you're just buying U.S. stocks. So if you want to hold a lot of U.S. stocks in a Canadian brokerage account, the best way to protect yourself there is to set up a holdco in Canada to hold those securities, and then you're protected from U.S. estate tax that way. The last way you can do it that a lot of people do just to avoid the hassle of going to a lawyer and getting all this done, is just own it jointly. And if one passes away, then the other one has the property, and you got to make generally a quick decision. I know, talking to my wife, if I was to pass away, she would probably die right away because, heartbreak. And so I don't know if that's a possible solution for us if we do buy a property. Some would say she's put it, well, no, forget it. I'm not going to talk about it. So, and then one distinction here that also applies in Canada to things here is the difference between joint tenancy and tenants in common. Joint tenancy just passes to each other, so it's a right of survivorship. Okay? If you set something up tenants in common, you essentially have a share each. So that won't work the same way. Okay? So if you're trying to avoid U.S. estate tax by setting it up tenants in common, not going to work because you each have a share. And then we've said there, you could use a qualifying domestic trust or a QDOT. Brent has got that on there. I'm not going through that because it applies to probably almost no one here. You really need to have a huge liability, and it probably is not going to be necessary for most people. One other thing, this is the last slide, but one last thing that I will point out. And this is something we've just sort of come into in the last few years, not related to tax, but if you have a property in the state of Florida and you own something there and spend a lot of time there, you need to get powers of attorney for the state of Florida. So if any of you here have that situation and you don't have powers of attorney in the state of Florida, the ones we've set up for you here are not going to be useful to you down there. Okay? It's one place that just doesn't, for whatever reason, they don't accept Canadian powers of attorney for things. So if you get sick when you're in Florida, or your one spouse wants to sell the property and the other isn't there, you need Florida power of attorneys for that. You don't, the Canadian ones won't work for you. Okay, so make sure you do that.
How about Arizona?
I think Arizona is okay. I think it's just Florida specific laws. That along with your driver's license, you've got to get an international driver's license, so make sure you do that. And then the last thing, it wasn't on the slides, but it might come up in questions, so I'll just touch on it. I don't know if you heard about the new proposed U.S. visa or U.S. foreign, I forget what they were calling it, foreign visa or whatever for Canadians, where they're basically have put through a proposal to allow Canadians to stay up to 8 months under this visa. And you have to meet specific rules in terms of your age, the fact that you own a property in Canada, so you're going to come back. And that is something that may come down the pipe. It looks pretty promising that they'll allow that, which would in theory, get rid of the requirement for the 8840 and the closer connection form, because if you meet the requirements of this visa, you'd be able to stay in the U.S. long enough to avoid worrying about being a U.S. Resident for tax purposes. The only thing with that, it hasn't been passed or anything. If it does, that seems like a great thing. Just again, want to be careful then about the actual 183 days and whether you're a resident of Canada, OHIP, all those other things would come into play. But that is a positive development that seems to be happening, because the U.S., I think, is, in their thirst for money on one side, is also recognizing that Canada is sort of a different thing here in terms of the amount of people who move back and forth for vacations or work or whatever. So anyway, just thought I'd touch on that, and I think that is the end of the slides. So I'll turn it back over to Stephen. So thank you.